What if I told you that timing the market isn't the key to wealth, but consistently investing, no matter what, is? Most people wait for the right time to invest. They wait for the market to drop, hoping to buy at the lowest point. Or they wait for it to rise, afraid of making a mistake. But in reality, even the most experienced investors can't consistently predict market movements. Now imagine this. If you had invested just Rs 5,000 per month in the Nifty 50 index over the last 15 years, your total investment of Rs 9 lakhs would have grown to over Rs 26 lakhs. That's nearly tripling your money, despite multiple market crashes, economic slowdowns, and global crises. This is the power of Rupee Cost Averaging, RCA. A simple but incredibly effective investment strategy that helps you reduce risk, maximize returns, and grow wealth without stress. I'm Jitin Modi, a personal finance strategist. And today, I want to show you why Rupee Cost Averaging through SIPs, systematic investment plans, is the smartest way to invest, even in a volatile market. If you've ever hesitated before investing, worried that the market is too high or too low, or tried to time your entry and failed, this will change how you invest forever. Most people make investing way more complicated than it needs to be. They believe they need to time the market perfectly, analyze charts, predict trends, and stay glued to stock prices every day. But what if I told you that successful investing isn't about picking the perfect time? It's about staying consistent over time. That's where Rupee Cost Averaging comes in. It's a strategy where you invest a fixed amount at regular intervals, no matter what's happening in the market. When prices are high, your fixed amount buys fewer units. When prices are low, it buys more units. Over time, this averages out the cost per unit, ensuring that you never invest all your money at a market peak and automatically take advantage of market dips. Think of it like buying petrol. If you buy fuel every month, sometimes you get more liters when prices are low and fewer liters when prices are high. But over the year, your average cost per liter balances out. You don't stop buying petrol just because prices fluctuate. You keep refueling because you need it. The same principle applies to SIP investing. This eliminates the need to time the market and prevents emotional decision-making. When investors panic, they make the worst possible choices, selling at a loss when markets fall and buying at high prices when markets rise. Rupee Cost Averaging stops this cycle and ensures you stay invested no matter what. One of the best ways to implement Rupee Cost Averaging is through systematic investment plans, SIPs. With SIPs, you invest a fixed amount in a mutual fund at regular intervals, typically monthly or quarterly. No market predictions, no guesswork, just consistency. Many investors waste years waiting for the perfect time to enter the market. But even the most successful investors in the world don't time the market. They stay in the market. If you're always waiting, you're missing out on years of potential growth. Imagine you invest Rs 5,000 every month in a mutual fund through an SIP. If the NAV, net asset value of the fund, is Rs 50, you buy 100 units. If the NAV drops to Rs 40, you get 125 units. If the NAV rises to Rs 60, you get 83 units. Over time, this lowers your average cost per unit and helps you build wealth steadily. This works best in a volatile market, where prices fluctuate regularly. Instead of fearing market downturns, SIP investors benefit from them by accumulating more units at lower prices. The problem is that most people let emotions control their investments. When markets crash, fear makes them sell at a loss. When markets rise, greed makes them buy at inflated prices. This cycle destroys long-term returns. Rupee Cost Averaging removes these emotions from investing. You keep buying regardless of price fluctuations. You stay consistent, whether the market is up or down. And over time, your patience is rewarded with compounding returns. But most investors make costly mistakes that limit their wealth-building potential. One of the biggest mistakes is stopping SIPs when markets decline. Many investors panic when they see negative returns and pull out their investments. But this is precisely when SIP works best, because you're buying more units at a lower cost. Those who halted their SIPs during the 2008 financial crisis or the 2020 COVID crash missed out on massive market rebounds. Another mistake is investing too much when markets are at all-time highs, assuming the rally will continue forever. Instead of investing a large lump sum, Spreading investments through SIPs reduces risk and prevents emotional decision-making. A third mistake is not staying invested long enough. SIPs and Rupee Cost Averaging work best over long periods, ideally 7 to 10 years or more. Investors who exit too soon don't allow compounding to work in their favor, leaving them with lower returns than those who stayed invested. If you had invested Rs £10,000 per month in a SIP in the Nifty 50 index for the last 10 years, your total investment of Rs 12 lakhs would have grown to Rs 23 lakhs, nearly doubling your money. Even through major market crashes, SIP investors who stayed committed saw their investments recover and grow significantly. So how do you implement Rupee Cost Averaging effectively? Decide on a fixed amount you can comfortably invest every month. Even Rs 1,000 per month compounds into something significant over time. Choose the right mutual funds based on your financial goals. For long-term growth, equity funds are best. For medium-term stability, balanced funds work well. Stay invested for at least 7 to 10 years. The longer you remain in the market, the better your returns. Increase your SIP amount every year as your income grows. Even a 10% annual increase in your SIP can significantly boost your final corpus. Most importantly, never stop SIPs during market crashes. Market downturns are when Rupee Cost Averaging works best, allowing you to buy more units at a discount. Wouldn't it be great if you could invest worry-free and watch your wealth grow steadily over time? With SIP and Rupee Cost Averaging, you don't need to guess market trends. You just need to stay consistent. If you're still waiting for the right time to invest, you might already be losing valuable time. The longer you delay, the harder it becomes to achieve financial freedom. Market volatility can be intimidating, but staying on the sidelines means missing out on years of potential growth. The smartest investors don't try to time the market, they stay in the market. Consistency and discipline always outperform guesswork. But simply knowing this isn't enough. You need a structured investment plan tailored to your financial goals. If you need personalized guidance, you can book a free one-on-one clarity session where I'll help you design a SIP strategy that maximizes returns while minimizing risk. If you prefer learning at your own pace, I've created a detailed ebook explaining SIP strategies, Rupee Cost Averaging, and how to invest wisely over time. And if you want ongoing support and expert insights, you can join my exclusive WhatsApp group, where we discuss investment insights, market updates, and strategies to build wealth with discipline. All the links to book your session, download the ebook, and join the community are in the description. Start investing the smart way and let consistency, not fear,